But good evening and welcome to the Ajax Public Library's program Adulting, Getting Your First Mortgage and Buying Your First Home, presented by Hannah Stojanovski from Mortgages with Hannah. I'm Julia Campbell and I'm the Adult Services Librarian at the Ajax Library. I just wanted to start by covering a couple of housekeeping items. So tonight's presentation is being recorded, so I would ask that you please keep your webcam and microphones off so that you are not displayed or heard in the recording. And this program will be posted to the YouTube channel of the Ajax Library in the next few days. And we will have a Q&A portion at the end of the presentation, at which point I will stop the recording to protect everyone's privacy. So at that point, you can feel free to unmute and turn your camera back on if you wish to do so. And of course, the chat button is there along the bottom. If you have any questions or comments along the way, you have the option of chatting with everyone, or you can send a private message to me, Julia. If you experience any technical difficulties, I recommend that you exit the Zoom and re-enter. If you continue to have difficulties, please place a comment in the chat and I will do my best to assist you. So now it is my pleasure to introduce our presenter, Hannah from Mortgages with Hannah. With more than 20 years of experience in the mortgage industry, Hannah's goal is to use her expertise and make the mortgage process as easy as possible for you. She has a passion for helping clients achieve their dreams of home ownership, and in 2018, 2019, 2020, and 2021, Mortgages with Hannah was the proud recipient of the Ajax Pickering Diamond Reader's Choice Awards for Best Mortgage Agent. We are very lucky to have her with us this evening, so without further ado, I will turn it over to Hannah to begin her presentation. Welcome, Hannah.
Thanks, Julia, and thanks for that warm welcome. That's so kind of you. I'm really excited to be here and share with everyone. As Julia said, I really have a passion for helping people get into home ownership and for the education piece, which is so important. So let's get started. Here's our team. So we have two underwriters, Barb and Laura, and Miranda. She's the first person you'll see when you come in the door and the first person to answer the phone, and of course myself. We've been in business now in Durham. We just had our 7th anniversary, so that's exciting. Um, there's a little bio about me, which Julia went over, which is awesome. And we are, well, still open through the pandemic. Obviously, it's been a very busy real estate market for your virtual and now in-person appointments. So feel free to call the office to book your appointment at any time. We'd be happy to help whatever suits you best on the phone, on Google Meet, or in person. And rates are still low, but we'll talk about that in the presentation as well. This is one of my absolute all-time favorite quotes, and it's so relevant to the topic we're speaking about tonight. You can't really know where you're going until you know where you've been. So one thing, there's lots of things, but one thing that sets our office apart from other mortgage agents is we get that education piece. So you don't call necessarily when you're ready to buy a home. You can call a year before that and we can make sure you're on the right track. We'll cover the basics tonight, but we're happy to go over that one-on-one with you at any time. So feel free to reach out and do the discovery call. Tonight we're going to cover a lot of topics. Why use a mortgage agent, what is a pre-approval, what the documentation looks like, credit tips to get you there, what your down payment needs to look like, and then we'll briefly touch on some specific products, which we'll go over more when you're ready to buy a home because they may change by then. What you should plan for is as far as closing costs and 10 commandments, both now and during the mortgage process. So why use a mortgage agent? Mortgage agents are becoming more and more popular in Canada. We represent, about 35 to 40% of market share. So that means like between us and the banks, like walking into a bank to get a mortgage. And why use a mortgage agent is you get independent advice on your financial options. So we are not tied to any one lender. We do represent the lenders, but we don't have to, like, we could tell you the pros and cons basically of each mortgage product, what's going to suit you best. You save time with one-stop shopping. So instead of spending the next 4 Saturdays, shopping around to all the banks, we can do that for you with our lenders. We negotiate on your behalf. So we can see instantly who's got the best rate, the best privilege payment options, the best down payment product, whatever you're looking for, we can negotiate that for you. And what that means to you is more competitive rates and a more suitable mortgage product for you. We ensure you're getting the best rates and terms. When we're going over your personalized plan, we discuss your short-term goals and your long-term goals. And we make sure that this mortgage we're sourcing for you checks all those goals. a smooth closing. We have been doing this for years. We help over 100 clients every single year. So we're closing mortgages every week, and we are happy to help you make it a smooth closing. Expert advice, as Julia mentioned, last year I celebrated my 20th year in the mortgage industry. So I've been doing this for a number of years. And the big thing, oh, I should start with this, but no cost to you. This is kind of a myth too, or an unknown. Mortgage agents are free to you to use. If we're going to be using an A prime lender or an alternative lender, which is where most of our home buyers fall, there's no cost to you. The only cost for our services is when we use a private lender, and all of that is fully disclosed up front. But most lenders, no cost to you. And ongoing support and consultation. My team and I will now be here for the life of your mortgage to answer all the questions that come up and guide you to the next purchase or the cottage purchase or the renewal, whatever you have coming up and for the rest of your mortgage life, basically. Okay, so what is a pre-approval? So when you are ready to shop for a home, it's really important to speak to someone before you go buy a home. I find a lot of people, and there's nothing wrong with this, just a lot of people seem to do it when they're ready to buy a home, they call a realtor. And that's great. A realtor is going to be the person to sell you the home, but we really need to start with the finances and make sure that everybody's on the same page with how much you're pre-approved for, what the monthly payment's going to be, that you qualify once you've bought that home, that there's no surprises, right, in your income, your credit score, your down payment. We then hold a rate for you for 120 days while you shop. And that actually speeds up the process when you buy and takes away all of the unknowns and all of the mystery. What the documentation looks like. Now, this changes depending on new government regulations or what have you, but basically we want to verify your identity, so ID, photo ID. We want to verify your income and verify your down payment. Those are the high level items that we need. Credit. Okay, so I don't like that credit is such a big myth now, right? It's a big secret what goes into a good credit score. And what does the lender look for on our credit report? So we'll go over some tips about how to start that now so that when you're ready to buy a home, you're going to pass the credit test with flying colors, right? I will say a couple of things actually. Equifax changed their scoring system. So Equifax is our largest credit reporting agency in Canada. TransUnion is the other credit reporting agency. 99% of our lenders use Equifax. So if you're going to check your credit somewhere, a lot of banking services or credit cards that you have online provide you a free credit report. This credit report that you're pulling on yourself is a soft hit. It's not a hard hit. What that means is it doesn't affect your credit score, which is great. So you can check that as much as you want. You're looking for a service like Borrow Well that's linked to Equifax, whereas a service like Credit Karma is linked to TransUnion, just as good, but it may have different information. And if most of our lenders are looking at Equifax, I'm going to suggest you look at Equifax as well. So you can check your own credit score on a free service called Borrow Well. You sign up for their service and they send you your score and your report every month. Just ignore all the offers for credit cards. That's how they want to get paid. So they are going to send you all those offers. What are you going to look for on your credit report? What is your credit score? So generally speaking, to get the best rates and the best offerings from multiple lenders, you want a score of at least 680, if not, 7 and higher, right? A perfect score is 900. Seen a couple, but not many. 900 is absolutely perfect. So you want to know your credit score, and then you want to be able to watch that to see that improve as you put the rest of our tips to work. You're going to check that the following information is accurate. So your name, your address, your employer, your date of birth, and your debt obligations. So like credit cards, OSAP, cell phone, all those things. So why is this important? Because this could delay mortgage financing when you're ready. If the date of birth is incorrect, or if your name is incorrect, it may just cause hiccups along the way. Equifax, how Equifax keeps their records up to date is when people like me, like your credit providers or a credit card that you apply for or a line of credit, they take your application, first name, last name, date of birth, employer address, and when they pull your credit, they're actually sending that information to Equifax. So Equifax is just relying on all of us credit providers to give them accurate information. So if the person misspelt your address or your last name, you might have some errors on your credit report. So we can go over how to handle that together. This is one thing that a lot of people don't know. Cell phones or telco companies now have permission to report to your credit bureau. So it is just as important to pay your cell phone on time as it is to pay your credit card on time. We recommend, we highly recommend that you set your cell phone up on auto pay. So the bill is paid from your credit card or your checking account each month automatically, so you don't have to worry about a missed payment there. And then everything else reports: credit cards, OSAP, car loans. Most mortgage companies report now. A secret is, a tip is, you only need 2 to 3 trades or credit products reporting well over 2 to 3 years to have good credit. I personally recommend a credit card and a line of credit. And here's why. I first got my credit card, my line of credit, I think at 18. Like the minute I could, I went out and got them. I have now had them for over 20 years, right? Like, so that's the length in your credit history. Whereas typically things like cell phones, which don't actually count as a trade, or car loans or OSAP, I wouldn't count those per se because those are temporary. You know, we upgrade in car, we get a new car loan. The old car loan is paid off and we've got a new trade reporting. We pay off the OSAP, that's no longer reporting anymore. The cell phone, we changed from Telus to Bell, that's no longer reporting. Now we've got a new trade. Whereas a credit card and a line of credit, you can really keep those over the length of time. So that helps us with the 2 to 3 years, right? Having credit for a good amount of time. As a first time buyer starting out, the lenders will let you off with what we call thin credit. So maybe just one credit card. So that's okay. You definitely don't need 9 credit cards. I was speaking to a client one day and he had 9 and it was like one from the Maple Leafs game and one from the Blue Jays game. You definitely don't need that many credit cards. Think 2 to 3. And as first time buyers, we can even get away with one. The next most important thing is paying at least your minimum payment every month and on time. So even if it's a tight month and you can't pay the full balance, not having that missed payment is so important. And I'm a big fan of automatic banking. So what that means is the less time I can spend doing my banking, the better. And you can actually set up most credit cards now to pull the minimum payment from your checking account by the payment due date to avoid that late payment, which I think is genius because that's another way we can protect our credit card. If you can, I really suggest paying the full balance every month. So again, like there's an auto pay for your minimum payment, there's an auto pay for the full balance. They can take the full balance every month. You could put all your bills on your credit card, not pay any interest on it because you're paying the full balance by the statement date each month. The goal is really to keep your credit card balance and your line of credit balance under 30% of the limit. So if we think if we're starting out and the bank gives us $1,000 limit, we need to keep that balance under $300 every single day of the month. That's a tough go if you have, groceries or a car repair or gas, gas nowadays, right? So a couple of ways around this, keeping your balance below 30% of your limit, is paying your credit card each week. Every Friday, you can either have your credit card auto paid, like $100 from your checking account, or you can sit and manually pay it every Friday. So you're paying it weekly. So your average balance doesn't go over that 30%. Another way is as soon as you can, ask your credit card provider for a limit increase. Go as high as they will give you, and then just don't go anywhere near that limit when you're spending, right? I think one of my credit cards now is at 20,000. I'll never go near 20,000 on that credit card, but it helps having that distance between my monthly balance and the limit. So that's going to really help strengthen your score. So I hope those are some useful tips for you to help get a good credit report. If of anything you walk away with today, sign up for the free credit report at Borrowwell, and look at your score and report, and any questions, feel free to ask, right? My bonus tip, and I'll come back to this as well later in the seminar, is create a budget. There's a lot of free budgeting tools right now. One of my favorites is Dave Ramsey's everydollar.com. The premise behind that is every dollar before the month begins has a purpose. So you are sending that dollar on a mission, even if that mission is, I'm going to budget X amount of dollars for Timmy's coffee. That's fine. You're giving your money a purpose before the month begins. It's so important to keep your credit score high, to keep your budget in check. Saving. So for down payment and closing costs. So when you come to our team for a pre-approval, we're going to tell you everything you need to close on that house, including all the fees at the lawyer's office. We're going to give you our estimate, and then we're going to work closely with the law office to make sure we're on track for that estimate. So how much do I need? How do I save it? And where should I save it? Let's start with the closing costs here. The top 10 closing costs are land transfer tax. As a first-time buyer in Ontario, you do have a rebate towards the land transfer tax of up to $4,000, which is fantastic. That really helps. That's when you're buying your first home if you haven't owned another home anywhere in the world before. Duly note though, if you're buying a home in Toronto, there is two land transfer tax now, the municipal land transfer tax billed by the City of Toronto and the provincial land transfer tax billed by the province. Tax on mortgage default insurance. So if you put less than 20% down, we have to purchase mortgage default insurance. The PST on that is paid at the lawyer's office. Legal fees for a purchase nowadays are going to be about $1,500. Costs for a newly constructed home may be billed at the lawyer's office. Prepaid costs and adjustments. So what that means is if the previous owner, paid the taxes or the water bill for the time that you were in the home, you kind of have to pay them back. The lawyers figure that out. A home inspection is always recommended if you can get a home inspection done. Home and fire insurance is more of an ongoing cost, whether you pay monthly or once a year, but that's now a cost of owning your home. Title insurance protects both you and the lender against title fraud, very important, and again, paid for the law office. An appraisal fee. This is really determined by the lender if you'll need an appraisal or not. That fee is not paid at the law office, it's paid in advance. It's about $400 to $500 in Durham. And moving costs, whether it's pizza and a U-Haul with your friends or a moving company, we want to try and estimate for that as well. Like I said, we estimate for all the costs, to get you into your home. Closing costs will be, I'll back up a slightly here. Closing costs for a first-time buyer outside of Toronto, we estimate 1.5% of the purchase price. So if we're buying a home that's about 500,000, our closing costs are going to be about 7,500. That accounts for the first-time buyer rebate, right? So on top of our down payment, we need 2,500 for closing costs. Down payment. Okay, so the minimum down payment for a home is 5% if the purchase price is below 500,000. If we're above 500,000, like our example here on this slide, it's 5% of the first 500,000 and 10% for any amount above 500,000. So in this scenario with a $700,000 purchase price, we're looking at least 45,000 down. That's going to make our closing cost of 1.5% of the purchase price, 10,500, and our total savings goal is 55,500. I think that's a reasonable goal for a home buyer to have is 5% down. In this market with the current government rules, if we were buying a home $1 million or above, the minimum down payment is 20%, which is 200,000. It's really pricey. So I would say the goal for first-time buyer is to have at least 5% down for a home that's under $1 million. Then I think we've gone back, especially in this market, to the days where we buy that starter home and move up in a few years, right? When we have the equity from our current home to put into the next home. So that's our savings goal on a $700,000 home. How do I save? The number one way to save is by cutting your costs. It is. Our income is really our biggest wealth building tool, right? Spending less than we make. How can we increase our income? We can ask for a raise at our job. We can apply for different higher paying jobs. We can find a part-time job to supplement our income. I love this, especially now, especially in the pandemic, coming out of the pandemic. I feel that people have gotten so creative with ways to make money. I mean, look at booming industries like, working from home, having a business from home, Uber Eats or Uber delivery driver. Like there's so many options. Depending on, the length and the type of the part-time income, we may not be able to use that on the mortgage application because there's stricter qualifying for business owners and part-time people, but you can save every penny of that income for your down payment, right? And for your closing costs. So finding more income is a great way to save more. Um, have a SMART goal. So really, once I find that people meet with us and say, I'm ready to buy a house, my goal is in a year, I find they're fired up and they're ready to start doing whatever it takes to saving. So that's, living below their means, having that budget, saving that extra money. Enlist support for your goal from family. If you're lucky enough to have, a mom and dad that can gift you some money, that's a fantastic way to get into home ownership. Um, Pre-authorized transfers. I love this. And how many times have we heard the old adage, pay yourself first? So when your paycheck hits your bank account, automatically have a percentage or a fixed amount go into your savings for your future goal of buying a home. It's so, so important. But that's, I mean, you've all heard of SMART goals, but that's a SMART goal is it's going to be specific. It's going to be measurable. It's going to be attainable. You can't realistically save 2,000 a month if you only make 2,000 a month. You've got expenses as well, right? It's going to be relevant and it's going to be time based. Let's get you into a home as soon as possible, right? Oh, I love this slide actually, and we've recently hired a financial planner to help with our own finances, and I just think they're a wealth of information. So let me differentiate here. A financial planner is a CFP, a certified financial planner. Typically, they are fee-based, which means you pay them for a specific service. For example, $250 to help clean up your budget, right? It's specific service. Whereas a financial advisor or an investment advisor are typically selling you products. So term insurance, RSPs, TFSAs, those kind of things, right? So you need to enlist the help of a financial planner who will help you make that budget and set those SMART goals with you. And then perhaps an investment advisor who's going to, help you put that savings, whether into a TFSA or an RSP. On that note, I always recommend that our clients have money saved in one of three locations. The RSP is a great place to save for a home. Each first-time buyer can take up to $35,000 out of their RSP towards a down payment. So if there's two of you on title, you can take 70,000, 35 each, right? Then you have 15 years to either pay that back through contributing to your RSP again, or take that as taxable income. So you add a little bit to your income each year and you pay it back that way to the government. Um, the beauty of that is um, you can really access some great interest rates through the RSP and help you speed up your savings, right? One thing I should note, your RSP money does have to sit for 90 days or seed for 90 days. So if you get a big lump sum of a tax return today, for example, and put it in your RSP, you can't take that money out until, mid-June. The money has to sit there for a minute. Um, Along with RSP, I always recommend you have some savings that's fairly liquid, fairly accessible. And what I mean by that is a TFSA or savings account, or even the checking account if it's short term at your bank where you can walk into the bank branch and access it immediately. And the reason why is most of your down payment and closing costs will be paid at the lawyer's office a week before closing. So you can put your money in an RSP and access it well in time to close on your home. However, when your offer is first accepted by the seller, within 24 hours, we have to provide a good faith deposit. So some of your down payment in advance. RSP money typically takes 3 to 5 days to access, and this good faith deposit has to be provided within 24 hours. So I recommend you keep some money aside, whatever your realtor advises in the current market is a strong deposit in your checking or your savings or your TFSA, like I said, at the bank branch. So you can walk into the bank branch and get that check. And then we can access the rest of your down payment closer to closing. That's just one way that my team helps plan ahead with you. So we're not putting out fires later, not able to access deposit money, right? The next thing we're going to talk about is income. So what documents do we look at? I joke, but it's so true. The easiest way to get a mortgage is for the full-time employee, full-time salaried employee, job letter and pay stub. We do mortgages for business owners. You just have to be in business for a couple of years. And we do mortgages for people who earn bonuses, commission, part-time, hourly, variable income. We just need a bit longer to prove your income, to prove the track records to the lender. For those kinds of things, we might need 2 years of T4s or 2 years of tax returns to the CRA. So it may just take a bit longer to get to our goal, but we can still definitely do it. The stress test. What is the stress test? The stress test came around in end of 2017, beginning of 2018, after our last really busy real estate market. The government brought out the stress test to help homeowners buy within their means in case interest rates were going up, which is the environment we're in now. What it means is the rate on your mortgage, the rate your payments may be based on and that you're paying interest on is, say, today around 3%. The stress test, the rate you have to qualify at is the Bank of Canada benchmark, which is 5.25%. So the government is stressing our income to make sure we can qualify at rates that are 5% in case, by the time we're renewing this mortgage, rates really are 5%, right? They're trying to protect us for the future. What this means, though, unfortunately, is we have lost about 20% of our buying power. And as you know, in these nutty markets, every penny helps. So one way to get around it is, I'm going to eat my words from before, but it is to have 20% down. At 20% down, we have credit unions and alternative lenders that will do things differently so that we don't need to qualify with that same stress test is the first way around. And the rates are very similar to, our what we call our A prime lenders. So rates are very similar. Another way is having a cosigner. It used to be that, mom, dad, or aunt, uncle, or grandma, grandpa used to help out with a gift of a down payment. Now with the stress test, the new way to help first-time buyers get into home ownership is having a cosigner, if possible. Adding that extra income will help us get around the stress test. Generally speaking, in today's qualifying environment with 5% down, you're going to qualify for 5 times your income. With 20% down, you're going to qualify for about 6 to 7 times your income. So those are some real rough numbers to keep in mind. There's a bunch of factors that come into that, like how much are the property taxes on the home, how much are your monthly debt payments, like your car payment or your student loan payment, and also how much of my income will the lender qualify me for, which we've got the expertise to go over with you. So we could definitely go over that one-on-one. Again, I'm going to talk about budget again because that's so important when not only planning for your first home, but when you actually get that home and you've now got the mortgage to pay, the utilities and the taxes. One trick of the trade, if this is possible, this is my favorite way that my first-time home buyers are successful with buying a home, is put aside what you estimate your mortgage, your property taxes, and your utilities to be. Say you estimate this is going to cost you, rough numbers, $2,000 a month for all these things. You're going to save that now on top of your rent. If you're already paying $1,000 in rent, say save $1,000 a month. That way you kind of get used to that money leaving your bank account already. So there's not so much of a payment shock when you actually buy the home and get the mortgage, but also that's adding to your savings for your down payment, right? So that's a little trick that we offer our first-time home buyers who are saving. Let's talk about mortgage default insurance. So mortgage default insurance really gets a bad rap, and I think it's a great, great, great product. It's been around for decades. We have 3 mortgage default insurance providers. CMHC is the government-run one, Canada Guarantee, and Sagen. So what they do is when we have less than 20% down, they actually assist us to getting into home ownership. However, we have to buy this insurance premium. It's not paid up front, though. It's added to our mortgage and amortized over the 25 years. The only thing that's paid up front is the tax on the premium that we covered in our closing costs. So 5% on a $500,000 home, 5% down is a $25,000 down payment. Your insurance premium is going to be $19,000. So the cost of insurance premium is tiered. So when you put 10% down, your premium actually goes down. So you can see the chart going a little bit backwards here. So 5% down, the premium's 4%, or 19,000 of this example. 10% down, the premium goes down to 3.1%, or 13,000 in this example, then 15%. And then at 20% down, there's actually no mortgage default insurance premiums required and access to the 30-year amortization. With less than 20% down, we're restricted to 25 years amortization. And a lot of people say, I don't want a mortgage for 30 years, and that's fine. That's one goal we can tackle later. Our immediate goal is to get you into home ownership and get around that stress test, right? So mortgage default insurance, like I said, it really gets a bad rap, but it's a fantastic product for getting you into the market with 5% down. Think about, on a $500,000 purchase, how quickly you can save up 25 grand based on your new and improved budget versus how quickly you can save up 100 grand. And by the time you save up 100 grand, our house price is no longer 500,000. Is that a moving target? Is that attainable or not? Only you'll know that when you're setting your SMART goal to set up your down payment savings goal, right? Purchase plus improvements. When you get to that home buying stage, this is such an exciting product because a lot of people nowadays, majority of shoppers are looking for that finished home, what we call turnkey. You walk in and the home is done and everything's beautiful. What I tell my first time buyers to do is look for that home that's in a great location. It's got great bones. You know, you love everything about the house except it's got wallpaper or green shag carpet or, cosmetic things that are fixable. You might get into that home with little to no multiple offers. First of all, hopefully, right? Because everyone's over here bidding for the beautiful, already done home. But second of all, depending on your mortgage qualification, we can add those renovations that you're going to need to do to the home to the mortgage. So you're not funding that out of your savings. We're actually getting the lender to loan us the money because those improvements are immediately going to improve the value of the home. So the lender is happy to do that, right? So if this is something that works for you, we can specifically walk you through the plan. But some quick numbers here are, if we were just going to buy the home for 500,000, that's 25,000 down. Now let's say we're going to do some renovations of 25,000. That can be, kitchen or a small kitchen and a bathroom, or lenders love flooring and paint. It's these little things that actually add so much value to the home, right? So if we bump up the purchase price, quote unquote purchase price, to 525, that's the cost of the home plus the renos. Your down payment, because it maintains 5%, it only goes up to 27,500. That's 2,500 out of your pocket today to get 25,000 in renos. That's amazing, right? Your mortgage amount doesn't go up by the cost we're adding for the renos. That adds about $115 to your monthly mortgage payment. To borrow 25,000 to get those renovations done, to get you into the market of homeownership, to that house that maybe other people walk past because the kitchen wasn't done or the carpet was green. That's one successful way to get you into the home, right? This product applies the green energy home rebate if you buy a home and have mortgage default insurance. This is really neat too. So if you buy a new build, like a condo or something, and it's energy efficient, we can immediately get a rebate on that mortgage default insurance premium that you paid. If you buy a home and you're going to make some energy upgrades, we get a reading, you do those upgrades, we get a new reading, you get a rebate on your mortgage default insurance premium, money back in your checking account. It's awesome. So that's another product we can talk about to get you money back after you buy your home. My 10 commandments. I am British and a little sarcastic, but also completely on your side and looking out for your best interest. So once we start planning your pre-approval and all that, these are just things that you need to be aware that may affect your pre-approval. So anytime any of these things might apply to you, feel free to reach out and I'd be happy to walk you through if it does or not, right? So the first one, thou shalt not change jobs, become self-employed, commissioned, or quit your job. And I laugh at this one because I quit my job 7 years ago to start the business, but that does change how you qualify for a mortgage, right? Like I was saying, business owners need to have 2 tax years of income under their belt, whereas an employee might just need to be out of probation with a job letter and a pay stub. So that's important when planning your home too. Do you want to, pause your dreams of business ownership and stay being an employee to be qualified for the mortgage, right? Number two, thou shalt not co-sign a loan for anyone. So if you co-sign a car payment or a loan or anything, that other person may be, quote unquote, responsible for making the payments, but that shows up on your credit report. And we now have to service that debt while we're qualifying you for a mortgage. That might reduce your buying power. And that's if they're making the payments on time. If they're not making the payments on time, that shows as a missed payment on your credit report. And you might not qualify for the home now because your credit score may be bruised. Thou shalt not buy a new vehicle, or you may be living in it. I'm joking. I don't want you living in your car, but it's true. I mean, we now with the stress test, how much debt we're carrying is more important than ever. So really keeping an eye on how much debt and do we need to upgrade from that $250 a month car to the $500 a month car? It's really a question we need to go over. Thou shalt not make charge cards excessively or make any late payments. So back to that utilization. We want to use 30% of our limit. That's it. No more than that. And no late payments. They stay on our record for 6 to 7 years. So we don't want any late payments there. Thou shalt not spend the money you have set aside for closing. So we estimate your closing costs at 1.5%. They may come out a little lower. I would rather that be a great surprise later than um, already spent the money on furniture or something for your home, right? Which is kind of ties in with number 7. That closing cost money is for closing costs. You buy furniture with another set of money or after closing when you know you've got the keys in your hand. Um, Thou shall not omit debts or liabilities from your loan application. So, like I said, we pull from Equifax. Sometimes Equifax doesn't have your car payment, or sometimes TransUnion does. Sometimes they're missing liability. So if you see something that we're missing, we need to know now before so we can make a plan for that rather than, we find out later. Um, Thou shall not originate any inquiries into your credit. Number 8. So, like I was saying, when you check your own credit, it's a soft hit. It doesn't have an effect on your credit score. However, when a third party, such as myself, checks your credit, it's a hard hit and it may or may not have an effect on your credit score. There's a whole mathematical equation that goes into that. I would say that normal Canadian consumerism has us having our credit checked about 3 to 5 times a year. Think of all the places that check our credit now, right? Our credit card may do it routinely. If we're going to get a new cell phone, they now do it. When you buy your home and you're signing up for utilities, some utility companies do it. So 3 to 5 times a year is reasonable. Equifax has recently made a change, whereas if you're shopping for a new car, if you're credit seeking from the same type of credit agencies like Honda, Nissan, Toyota, those credit pulls within a 45-day time span only count as one. So that they're protecting your credit score a bit more now. Thou shalt not make any large deposits without first checking with your mortgage agent. So payroll deposits are fine. A payroll bonus is fine. Depositing $5,000 in cash, we need to know why. We need to know a story. Did you get married and that was, all the wedding money from your friends and family? Where did cash come from? Large cash deposits are always questioned, right? Thou shalt not pay off any collection accounts or charge off prior to closing. Sometimes we have small collection accounts, small ones. I say, less than a few $100s that are there, but they're not really affecting your credit report. And sometimes when we pay them, we reactivate them and they may lower our credit score. Now's not the time to do that. If your credit score is already strong enough to get pre-approved, leave the collection until after closing of your mortgage and then pay it off. If depending on the dollar amount and the lender may ask that you pay it. That's one thing, but we're not going to stir the pot if they're not asking about that. Our team is experienced in helping you through what happens on closing day with the lawyer. There's a lot of details here, but the number one thing I say is don't take closing day off from work. You probably won't get the keys to your house till 5 o'clock. You're not getting them at 9 in the morning. So don't take closing day off of work. Take the next day off, right? Oh, bonus. Get your own realtor. This is such a great tip that a lot of people don't know. So if you call the realtor who's listed the house, they have an obligation already to the seller. So they actually can't do their best by you because they have an obligation to the seller. My little analogy is, if you're being sued by someone, do you use their lawyer? No, you don't. You go get your own. So when you're buying a home, your realtor, called the buyer's realtor, is actually free for you. The seller pays all the realtor fees, not the buyer. So there is no cost out of your pocket to go and find your own expert. If you don't have an expert friend or family that you already know, we work with a bunch of amazing realtors in Durham, and we're happy to pass along a referral. Insuring your investment. This is another great thing to plan for when we're at the point of planning your mortgage, is making sure we get this insurance, term insurance, life insurance, whatever have you. We have great financial advisors that we work with to make sure that your now biggest asset and biggest debt is protected. And like I said at the beginning, we have complimentary mortgage consultations. Whether you're 6 months out or 12 months out, or just have a question after the seminar, feel free to reach out and we're happy to help with all of your questions. Thanks so much, Julia. That's everything I've got so far. Are there any questions?
Thank you so much, Hannah. That was so great. And those tips were amazing. I learned a lot, and I'm already a homeowner. So I can only imagine how much first-time buyers would have got out of your presentation. So
Oh,
I'm
that's
now
so
going to
great.
stop the recording to open it up for our Q&A.